When the market goes down, your stocks go down, right? Wrong. In this video, I'm going to be teaching you how to make money in the stock market, even when it's going down. So, stay tuned to find out exactly how you can do this. Before we get into this video though, I do need to tell you that I'm not a financial advisor. This is not financial advice. This video is purely for entertainment purposes only, and any risk you take on financially, whether in the stock market or not, is fully your liability and only your liability. None of that falls on me or anyone else. Now, let's get right into the video. So the reason I'm creating this video is because last video I told you guys the reasons that I think that the stock market might crash soon. So if you haven't checked that video out, go check it out right now. It's linked up above, and then come back to this video because that video will give you context as to why the market may go down and what may cause it to go down in the near future. Now that you've checked that out, let's continue on to how to make money when the stock market goes down. So there are multiple ways to make money when the stock market goes down. You can buy inverse funds, you can buy puts, and you can short stocks. I'll explain each of these in more details in a moment. But essentially, all three of them work the same way. They're all going against the market, where basically you bet your money that the market will go down instead of up. Now, these can be very risky and are really risky because the market generally goes up about 7.5% a year, according to about the last 20 years, averaged out in the stock market full year return. But if you time these things right, you can make a lot of money going the opposite direction. So I'll explain each of these three options that you can choose, and I'll explain the risk versus the reward for each one. Alright, the first idea here that we're going to get into is the inverse fund of a stock. So there's inverse funds which basically track the market but go the opposite direction. One well-known one that is inverse of the S&P 500 and is triple leveraged, which means it's going to go up and down 3 times as much as the stock market does, just opposite because it's an inverse fund. Yeah. And with this one, what you're going to be doing is you just buy it like any other stock, and that means that whatever price you get in at, when the S&P 500 goes down, your stock goes up, and when the S&P 500 goes up, your stock goes down. Yeah. What you really got to watch out for is reverse stock splits with these stocks, because when they do go down and they're triple leveraged, so they go down even faster than the S&P 500 normally goes up. So when they get to a certain price point, they tend to do reverse stock splits, where the stock jumps up in price because there's less stocks available on the market. So if you own, let's say, 10 shares, you might only have 1 or 2 shares left after the stock split happens, which it's going to be for the same price total, but you might get charged a fee because you hold it through the stock split, and it's like a reorganization fee or something like that. And you really don't want to be charged that fee, so just make sure to stay up to date on the news within those stock splits and what might be happening. But when the market does go down, then these stocks do go up quite a bit, and they are, well, I would say a little bit less risky than options. Now, let's get into our next point. Alright, the next idea here is that you need to smash the like button for the YouTube algorithm, because if you haven't, I don't know why not, because it seriously does help out the channel a lot, and it helps to push these videos out to more people. I mean, you wanted to learn how to go against the stock market, so who's to say somebody else doesn't? Just hit that like button for me. It also helps out the channel a lot and helps me on my road to 1,000 subscribers by the end of 2021. Alright. Now let's get into the actual second point here, which is buying puts. And I emphasize buying because if you sell them, you're on the other end of that. And I'll do a video on the other side of options where you sell the options sometime soon. And if that video is out, it'll be linked up above. But for the sake of this video, we're going to be buying the put. So you put in the buy order to buy the put. And if you don't know what any of this means, you can just kind of skip ahead to the next point, because I'm not going to go really in depth onto what options are and how you can trade them right now. And there's plenty of videos out there that you could go check out for that. But for the sake of this video, I'm just going to assume that you know what options are and what everything is and the Greeks behind it. So you're going to pick your strike price and you're going to set the expiration date that you think it can reach the strike price by and buy a put on it. And when you buy a put, that means you think that the market will go down. And if you're right, you can have huge gains, 100%, 200%, even sometimes 1,000 to 3,000% profit. The profit is endless. But the thing with that is that options are very volatile, and when it goes the other way, you can lose all of your money, or 50%, or really just whatever you put in, you can lose very quickly with options if the market goes the other way. Whereas if you had done one of the other ideas that I've listed here, that might not have happened so easily. Now, let's get into the third idea. So the third idea is to actually short the stock market, which if you don't know what shorting a stock is, I'll go into it briefly here. Shorting a stock is basically where your brokerage, which is like E-Trade, Vanguard, TD Ameritrade, whichever one you use, your brokerage will loan you a share of a stock or however many you want to be loaned. And in exchange for that, you're going to have to buy it back later. So if the stock actually does go down, you can buy it back at a cheaper price and you keep the difference. So that's how you make money with these. And it's a really great way if the stock market does end up going down to make money. But if it goes the other way, it can run on forever and ever and ever. So that's why I always like to put stop losses somewhat close on that kind of thing, because there's no limit to your downside. The only problem with shorting a stock and going against the market is that there's a limit to your upside. Your limit is 100%. That stock could hit zero, which if the S&P 500, which is our example here, if that hits zero, we got bigger problems in the United States and in the economy. So really, your upside isn't too much. It's kind of capped, but your downside is unlimited, which is why brokers are so willing to lend you these shares, because it's unlikely that you make a lot of money or even just make more money than they're going to make. Really, the risk reward pays off a lot more for them than it does for you. That's why I don't like to short the market. And also, you need a margin trading account to short stocks, which if you don't know what a margin trading account is, it's basically there's two types of accounts for brokerage, and one is a cash account, the other one is margin. Cash accounts, you're going to have to wait a couple of days for your trades to settle after you sell out of a stock before you can use that money again. Well, you can use the money again before that, but if you sell those stocks, you might receive a penalty and you might lose your account for 60 days, I think it is. Don't quote me on that because I'm not entirely sure on that, but I'm pretty sure that's what it is. If you have a margin account, you can use that money instantaneously as soon as you sell a stock. But if you have less than 25,000 in your account, you're going to be under the PDT rule, which is pattern day trader rule. And that means that you can only day trade 3 times in a week without having those same penalties and exclusions as you would with a cash account if you had sold your stocks early. Now, this is not a problem for most people because most people don't day trade 3 times a week. But if you're shorting the stock market or buying puts against the stock market, you might want to be in and out like multiple times a day. And using your 3-day trades, that can eat up quickly. So just watch out for that with a margin account. And make sure that you know what you're doing and you don't get stuck, because if they lock your account down, you could be stuck holding negative shares in your account, and then you'll owe the broker a lot more later if you get your account back and the market's been up a lot, which is not what you want to do. And that's why I really recommend setting a nice tight stop loss on your trades where you're going against the market, because the market can easily just go up and up and up. And if you're thinking, oh, I'll just wait for the next crash to sell out, you might be at a better price than how low the next crash is actually going to go to actually get some of your money back without losing too much. And you can lose even more than you sell those shares for. The stock market can double. While it's very unlikely, it can double. And you can lose even more than you were willing to put in there. So just be very careful with that. and I don't really trade stuff against the market. I tend to buy stocks in hopes that they go up because more often than not they do. All right, that's about all I got for you today. So thank you for watching, and make sure to like the video if you enjoyed or if you got any value out of it, because other people will find the same value that you did. And subscribe to the channel to join me on my road to 1,000 subscribers by the end of 2021. Again, thank you so much for watching, and I'll see you next Friday.